It began quietly, almost invisibly, in the early 1980s. As America's industrial heartlands rusted and global finance boomed, a new kind of power emerged, not in government halls or corporate boardrooms, but in discreet glass towers in New York and Connecticut. Hedge funds, small, aggressive, and secretive, promised outsized returns in a world addicted to leverage and speculation. Few understood what they truly were. Fewer still realized they would soon control the very arteries of American capitalism. A hedge fund sounds cautious, something to protect against loss. In reality, these were unregulated pools of money for the ultra-rich, designed not just to protect wealth, but to multiply it by any means. Their secrecy was their strength, their freedom, their weapon. Hedge funds operated in the shadows of markets where traditional rules didn't apply. Many of these early hedge fund pioneers came from elite universities, Harvard, Yale, Princeton, trained in mathematics and philosophy, not just finance. They saw markets as puzzles to be solved, systems to be hacked. One of them, a young investor named Julian Robertson, launched Tiger Management in 1980. His model would inspire generations of hedge fund giants. Robertson's Tiger Fund became a training ground for financial predators, the Tiger Cubs. They learned to read economies like ecosystems to hunt inefficiencies, prey on weakness, and dominate global markets. From these cubs would emerge future billionaires: Chase Coleman, Lee Ainsley, Andreas Halvorsen. Together, they would evolve hedge funds into a coordinated empire of influence. In the 1990s, the rise of derivatives and cheap credit gave hedge funds new weapons. They could now bet on anything: currencies, bonds, commodities, even countries. The scale of their power grew faster than regulators could comprehend. The traditional idea of investment gave way to something more abstract and dangerous. In 1998, long-term capital management, run by Nobel-winning economists, imploded under massive leverage. The US government had to orchestrate a bailout to prevent systemic collapse. It was a warning sign. Hedge funds were now too interconnected to fail. Yet, instead of restraint, the crisis fueled ambition. Wall Street learned one lesson: power brings immunity. By the 2000s, human instinct was no longer enough. Hedge funds turned to algorithms, digital minds capable of scanning global data faster than any trader. The markets became an arms race of code, each fund fighting for milliseconds of advantage. Data was the new oil, speed was the new power. Firms like Renaissance Technologies and Sigma turned market prediction into a science. Their founders, mathematicians, cryptographers, physicists, approached markets like equations, not economies. These quant funds made billions without making headlines. Their secrecy was near total. They didn't just predict the market, they became the market. By the time the great financial crisis hit in 2008, hedge funds were not just investors, they were political actors. Some helped crash the system, others profited from it. They funded campaigns, influenced regulation, and shaped narratives. The American economy was no longer just built, it was engineered. Today, hedge funds manage trillions, more than the GDP of most nations. Their strategies ripple through currencies, housing, and even food prices. The shadow finance empire is not a conspiracy, it's a structure, an invisible architecture of wealth and control. And like all empires before it, its rise carries the seeds of its fall. When the global financial system collapsed in 2008, it was supposed to be the reckoning, the great reset of greed and speculation. Yet for hedge funds, the crisis became an opportunity. While banks faced regulations and political backlash, hedge funds quietly moved into the vacuum. They bought distressed assets for pennies, turning global panic into private profit. In response to the crisis, the Federal Reserve flooded the world with liquidity. Interest rates fell to zero, and quantitative easing pumped trillions into markets. The rich borrowed nearly for free. Hedge funds, already masters of leverage, became the primary beneficiaries of this monetary flood. Cheap money was their oxygen. From 2009 onward, the Tiger Cubs and their rivals expanded aggressively. They bought real estate, corporations, even entire neighborhoods. The line between finance and ownership blurred. The very system that once punished excess now rewarded those bold enough to exploit its rescue. Hedge funds didn't just bet on the recovery, they owned it. The secret weapon of the modern hedge fund is not creation, it's acquisition. By specializing in distressed assets, they feed on economic decline. When nations or companies falter, funds buy their debt at bargain prices, then pressure for repayment. Profit born from crisis. Misery turned into opportunity. By the mid-2010s, hedge funds were not just American. They had global reach, moving billions across borders in seconds. The same fund that shorted Greek bonds could also buy US tech stocks or speculate on African currencies. This web of capital made nations fragile and interlinked, beholden to invisible forces. In this new world, a few names became legendary: Ray Dalio, George Soros, Paul Tudor Jones. They weren't just investors, they were philosophers of finance, betting on the fate of nations. Their decisions could shift entire economies. They spoke of cycles, empires, and psychology, blending ancient wisdom with modern power. After 2010, information itself became the battleground. Hedge funds began buying satellite imagery to track oil tankers, using AI to analyze consumer sentiment, and even scraping corporate emails. The market was no longer about instincts, it was about data dominance. The one who knew the world first won. As their power grew, hedge funds started influencing regulation itself, lobbying through think tanks, funding economic research, and positioning themselves as market experts. They helped shape the very rules that govern them. Democracy bowed to complexity. Policymakers often didn't understand what they were approving, and that was the point. By the 2020s, hedge funds had entered the last untouched market, the homes of ordinary people. Using shell companies and massive capital pools, they began buying single-family houses en masse. What was once the American dream became a rental line on a spreadsheet. Ownership was no longer personal, it was financialized. Today, hedge funds hold stakes in food supply chains, energy markets, and social media platforms. Their influence is subtle but omnipresent. They don't need armies or flags. Their empire exists in contracts, leverage, and data streams. It's the empire of liquidity, and it flows everywhere, unseen yet undeniable. Hedge funds don't just play the financial system, they design it. By controlling trillions in assets, they shape how capital flows through nations. When they buy bonds, interest rates fall. When they short stocks, industries collapse. When they move out of a country, currencies devalue. In a world built on liquidity, hedge funds are the engineers behind the invisible scaffolding of power. Power demands protection. Hedge funds, through political donations and lobbying, became one of the most influential forces in Washington. They don't need to own politicians, they only need to fund the conversation. Their language is complex, their influence subtle. Few voters even know their names, yet their fingerprints are on every financial law that matters. Knowledge has always been wealth, but in finance, it's domination. Hedge funds invest millions in gaining privileged access to data, not illegally, but early. Before the public hears about inflation or unemployment, the funds have already positioned themselves. This is the modern version of royal intelligence, economic espionage masked as analytics. Perhaps the most subtle relationship of all is between hedge funds and central banks. While central banks print liquidity to stabilize markets, hedge funds absorb and redirect that liquidity for profit. The two form a quiet symbiosis. One keeps the system alive, the other exploits its heartbeat. Neither can exist without the other. The term free market is sacred in modern capitalism, yet it's a myth. Hedge funds manipulate prices, influence liquidity, and dominate trading volume. They decide when risk exists and when it doesn't. Markets, once thought to reflect collective wisdom, now often reflect collective strategy of a few hundred powerful firms. Algorithms have replaced intuition. Hedge funds deploy thousands of automated systems that trade without emotion, without pause, without humanity. These algorithms monitor news, tweets, and even the tone of central bankers' speeches. The result, a market that feels human but moves like a machine driven by logic loops and profit signals. Markets aren't just numbers, they're emotions quantified. Hedge funds understand this through subtle narrative manipulation, media, sentiment analysis, even influencer investments. They shape how people feel about money, risk, and security. A rumor can shift billions. Perception itself is a tradable asset. When a hedge fund bets against a country's currency, it can destabilize that nation's economy. This is not theory. It has happened repeatedly, from Asia to Latin America. A handful of managers can create capital flight, inflation, and political turmoil. In a globalized system, financial moves carry geopolitical consequences sometimes greater than any army. Universities, pension funds, endowments, institutions meant to protect public welfare are now deeply invested in hedge funds. They depend on these returns for survival. The result, a quiet alignment of public good with private profit. The system cannot criticize itself, because it feeds from the same trough. The modern hedge fund world doesn't conquer through land or law, it conquers through flow, the constant movement of money. Their empire exists wherever liquidity exists. Stock markets, commodities, even cryptocurrencies. It's not a kingdom of stone, it's a kingdom of current. Always moving, always invisible. By the 2010s, hedge funds had become engines of wealth concentration. While average workers faced stagnating wages, hedge fund managers earned in a single year what an entire town might earn in a lifetime. The American dream, once rooted in hard work, was quietly rewritten into a system of financial inheritance and algorithmic advantage. Every empire has its middle, its backbone. In America, that middle class once balanced the economy. But as hedge funds redirected capital from production to speculation, industries hollowed out, factories closed, jobs vanished, and the wealth gap widened. Finance no longer built, it extracted. Hedge funds entered real estate not to live, but to own. They bought thousands of homes after the 2008 crash, turning them into rentals for families. Home ownership became a dream deferred. For hedge funds, it became steady income. What was once a neighborhood became a portfolio. In finance, efficiency means cutting costs, but in the real world, that means cutting people. When hedge funds acquire companies, they restructure ruthlessly, closing departments, automating processes, offshoring jobs. What looks like a lean business model on paper is often a community's slow death. In an industrial economy, value comes from creation, from making things. In a financial economy, value comes from extraction, from moving capital faster and smarter than anyone else. Hedge funds mastered this transformation. But as profits rose, the human connection to labor, time, and worth began to dissolve. Economic inequality doesn't just distort markets, it distorts democracy. When a few hedge fund managers can spend more on lobbying than entire unions, representation shifts from the majority to the minority. The vote still matters, but the money speaks louder. Power becomes a commodity auctioned to the highest bidder. Wealth changes culture. Hedge fund billionaires began to shape taste, philanthropy, and even art. Museums, universities, and think tanks now carry the names of financiers. Their influence extends beyond economics into the very narrative of civilization. What we remember, what we value, who we praise, all increasingly filtered through wealth. Money doesn't just buy influence, it buys silence. Many hedge funds have partial ownership in media conglomerates, PR agencies, or digital networks. Narratives are softened. Criticism is nuanced. The public rarely sees the invisible editors who decide which truths are told. In finance, people become data, employees become labor costs, homes become assets, communities become markets. This abstraction allows profit to exist without guilt. Yet, behind every percentage point of return, there are lives adjusted, displaced, or erased. As inequality deepens, trust erodes in institutions, in government, in fairness itself. The more complex and abstract the financial world becomes, the more alienated the public feels. And history teaches us, no empire, financial or otherwise, can survive once its citizens stop believing in its promise. As the 21st century unfolded, hedge funds found a new battlefield, not on Wall Street, but in cyberspace. Data became the new gold. The fastest traders, the smartest algorithms, and the most predictive models were the new kings. The digital revolution wasn't just about convenience, it was about control. By the early 2010s, more than 70% of all trades on US exchanges were executed by algorithms. Hedge funds like Renaissance Technologies and Two Sigma pioneered the use of artificial intelligence in finance. Their systems didn't think like humans. They learned, adapted, evolved. They found patterns invisible to any analyst. In finance, milliseconds mean millions. Hedge funds built private fiber optic cables connecting exchanges, shaving microseconds off trade times. Some even placed their servers closer to exchange computers to gain fractions of a second. It was a digital arms race, invisible, relentless, and ruthlessly efficient. Every online purchase, tweet, or GPS signal has value. Hedge funds began purchasing alternative data, from credit card transactions to satellite imagery, to predict market trends before the public knew they existed. The modern investor no longer looked at balance sheets, they looked at human behavior. In the digital age, quant funds became the new alchemists, turning information into fortune. They didn't rely on intuition but on mathematics, regression models, neural networks, and Monte Carlo simulations. Their success wasn't about understanding the world, it was about predicting it. As hedge funds tracked everything from foot traffic to weather patterns, privacy became collateral damage. We entered an era of financial surveillance, where algorithms watched us not to protect us but to predict and profit from us. The market no longer reacted to reality, it anticipated it. The more digital finance became, the less visible it was. Transactions occurred in microseconds, across continents, between machines. Value itself detached from tangible goods and drifted into abstraction, into code. The economy had become a ghost, moving too fast for human eyes. Hedge funds no longer belonged to nations. They were borderless, fluid, omnipresent. A decision made in a Manhattan office could ripple through Asian markets within seconds. Sovereignty itself, once the foundation of governance, began to blur under the dominance of global capital. In the age of algorithms, human emotion became a weakness. Machines didn't fear crashes or celebrate profits. They optimized, they adapted, and in doing so they became the new rulers of finance, silent, tireless, and indifferent to human cost. Today, the hedge fund world stands at the intersection of finance and artificial intelligence, a place where profit meets prediction. But in the shadows of this progress lies a question. What happens when the system becomes so complex that no one truly understands it anymore? When the empire of money becomes self-aware, every empire in history grows until it can no longer sustain its weight, and the empire of hedge funds is no exception. The sheer scale of global financial leverage has reached astronomical levels. Trillions circulate in invisible loops of speculation, detached from productive reality. When finance becomes the world's heartbeat, even a small misstep can trigger a global seizure. Crashes rarely come from where we expect. In 2008, it was mortgage-backed securities. Tomorrow it could be derivative exposure, digital asset contagion, or sovereign debt implosion. The system is faster, larger, and far more interconnected than ever before. The same algorithms that promise stability can amplify chaos. Hedge funds thrive on leverage, the art of using borrowed money to multiply bets. But leverage is a double-edged sword. It magnifies profits during booms and multiplies pain during busts. In moments of panic, when everyone tries to unwind at once, liquidity vanishes like a mirage. The empire's foundation, built on borrowed confidence, begins to tremble. When markets crash today, it's not just fear, it's feedback. Algorithms react to price drops by selling faster, amplifying volatility, and accelerating collapse. It's a self-reinforcing spiral that no one can stop. The machines don't panic, they execute. The result is an automated cascade, a financial domino effect written in code. Investors seek safe havens, US Treasury bonds, the dollar, gold. But what happens when even the safest assets are backed by a system stretched beyond belief? When the guardian itself, the central bank, becomes the insurer of last resort, printing confidence out of thin air? Safety becomes illusion, and illusion becomes currency. Amid uncertainty, humanity often returns to what's tangible: labor, land, and production. When the financial towers tremble, people rediscover the value of creating real things. The post-financial era may not be a collapse, but a rebalancing, a slow shift from speculation to sustainability. Not all change means destruction. Some hedge funds will adapt, merging data science with ethical investment. A new breed of financial institutions may rise, transparent, decentralized, community-driven. They'll wield algorithms not as weapons of extraction, but as tools of empowerment. The empire might evolve, not end. Blockchain, decentralized finance, and digital assets promise to return power to individuals. But decentralization is not guaranteed freedom, it's responsibility. The same tools that liberate can also enslave if they replicate the same greed under a new name. Technology alone cannot fix human nature, but it can reveal it. Even as finance evolves, the old power networks remain. The same families, institutions, and funds quietly adapt, shape narratives, and influence policy. The empire of money never truly disappears, it merely changes form. The shadow still lingers, because it lives within us, in our choices, desires, and fears. The story of hedge funds is not just about power, it's about perspective. It's a reminder that every empire, no matter how powerful, is built on collective belief. We, the people, are both its foundation and its limit. The future of finance will not be written by algorithms, but by our ability to understand, question, and evolve.